Why most traders fail miserably? Let's be honest. Most traders don't fail because they lack intelligence or resources. They fail because they don't have a proven process. They're reacting to noise, financial news, online tips, gut feelings, instead of acting based on a strategy. William J. O'Neill, the legendary investor and founder of Investors Business Daily, saw this firsthand. He spent decades studying history's top performing stocks and discovered that their success followed consistent patterns. From that research, he developed a powerful yet simple system, CANSLIM. This system isn't about chasing the hottest meme stocks or gambling on penny shares. It's a disciplined, research-based strategy for identifying high-growth stocks early, before they make their biggest moves. In this book situation summary, we'll walk through each part of the CAN-SLIM strategy, highlight the psychology behind successful trading, and give you practical takeaways to apply right away. Let's dive in. What is CAN-SLIM? CAN-SLIM is an acronym that stands for the 7 traits of winning stocks. It combines fundamental and technical analysis, giving traders a comprehensive lens through which to evaluate potential investments. Each letter represents a core factor O'Neill found in virtually every top-performing stock, whether it was Amazon in the early 2000s or Apple in the 2010s. C. Current quarterly earnings per share. O'Neill found that most big winners posted explosive quarterly earnings growth, often 25% or more, just before their stock price took off. This makes sense. When a company beats expectations, institutions notice. And when big funds start buying, prices rise fast. Look at Nvidia in recent years. Massive EPS growth in key quarters attracted waves of institutional money, pushing the price to new highs. So, the first rule? Only consider stocks with strong, accelerating quarterly earnings growth. No earnings momentum, no entry. A. Annual earnings growth. While quarterly growth is great, it must be backed by consistent annual performance. O'Neill recommends looking for stocks with at least 25% annual EPS growth over the past 3 years. These are companies that are executing long-term strategies successfully, not just enjoying a lucky quarter. This shows stability and strong demand for their product or service. For example, Tesla showed consistent multi-year earnings growth before its major rallies. N. New product, service, management, or price high. O'Neill noticed that a major catalyst often accompanies stock breakouts. A new product launch, new leadership, or the stock itself breaking out to new highs. Think iPhone for Apple, streaming for Netflix, or ChatGPT integration for Microsoft. These new elements attract market attention. Also, a stock hitting new price highs is a bullish sign. Many avoid stocks at new highs out of fear, but history shows that's often when big moves begin. S. Supply and demand. The law of supply and demand is the engine of the market. Stocks with limited supply and surging demand have no choice but to go up. That's why O'Neill prefers companies with smaller floats and big spikes in volume on breakout days. When volume surges while the price rises, it shows demand is overwhelming supply. That's when you want to ride the wave. L. Leader or laggard. You want to bet on the fastest horse in the race, not the one limping at the back. O'Neill developed the relative strength RS rating to help you do just that. Focus on stocks with RS ratings of 80 or higher. They're outperforming 80% of the market. Leaders tend to get stronger. Laggards drag your portfolio down. It's that simple. Bank I. Institutional sponsorship. Big money drives big moves. You want to invest in stocks that are being accumulated by mutual funds, pension funds, and hedge funds. These institutions don't buy lightly. They do massive research before investing. Look for increasing institutional ownership, especially from top-performing funds. But beware of overcrowded stocks. Once too many institutions are in, upside becomes limited. Down. Market direction. Even the best stock can fail in a bad market. O'Neill emphasizes that you must always trade with the market trend. Use major indexes like the Nasdaq and S&P 500 to judge overall direction. Learn to read follow-through days, distribution days, and moving averages. If the market's in a confirmed uptrend, be aggressive. If it's in correction, sit tight or go to cash. Discipline here is everything. Trading psychology. Why most traders quit. O'Neill's book isn't just about buying great stocks. It's about becoming the type of trader who can consistently win. And that begins with mindset. The market doesn't reward hope. It rewards preparation, discipline, and execution. Most traders hold losing trades too long and sell winners too early. They let ego, fear, and greed take control. He urges, cut all losses quickly, at 7 to 8% max. No exceptions, never average down, and never fall in love with a stock. Be a machine. Treat this like a business, not a casino. Common mistakes that kill traders. O'Neill lists the mistakes that destroy portfolios. 1. Buying low and selling high. Sounds good, but most winning stocks are already hitting new highs when they begin their move. 2. Ignoring the market trend. Trading against the overall market direction is a recipe for disaster. 3. Not using stop losses. Hoping a loser will bounce back usually ends in bigger losses. 4th, averaging down. Doubling down on losers magnifies mistakes. 5. Failing to study history. Past winners show patterns. Learn them. Book chart patterns that trigger breakouts. O'Neill loved chart analysis. His favorite pattern? The cup with handle. It reflects accumulation, a short shakeout, and then a breakout. He also recommends flat base, a tight sideways range, double bottom, a W-shaped recovery, ascending base, series of higher lows forming a staircase upward. These patterns work best when paired with strong volume and can-slim fundamentals. Final thoughts. It's not luck, it's strategy. Most traders treat the stock market like a gamble, but the real winners approach it like a business. O'Neill's can-slim system has created millionaires, but only for those who studied it, applied it, and stayed disciplined. If you're tired of trading based on noise, if you're ready to follow a proven path, this book is your starting point. Because at the end of the day, it's not about finding the next big stock. It's about becoming the trader who knows exactly what to do when they find one. This is Booksituation, and this was How to Make Money in Stocks by William J. O'Neill.